Okay, so for this next video lecture, so we will be focusing on the topic about goals and tools of financial managers. Okay, so here we have first to define who is a financial manager. Okay, so a financial manager is someone who is responsible for monitoring the financial health of an organization using financial reports. Okay, so here he is the one who takes care of the financial health of the organization, and by doing so, the tools and the data that he is using to aid or to help him in doing his responsibilities. Okay, so that is coming from the financial reports. Okay, so when things are going well, they direct investment activities, and they also develop plans that can help maintain or improve the financial status of the company. So based on this description of who is a financial manager, so we can say that his role is considered to be vital in, especially in the survival and in maintaining of the business in the long run. So here, when things gone badly, so they will develop strategies to improve the company's finances. So not just for a short term, but also in the long run. Okay, so aside from directing investment or investing decisions, they also develop strategies on how to cope with financial difficulties. Okay, so they often use their knowledge of the company's finances to help provide advice to the top management for them to make sound economic decisions. Okay, so the goals of the financial managers. So first is they have to do planning. So this is very important. Okay, so planning is or the financial managers focus on planning in a long-term financial strategy. So they assign the actual bookkeeping work to their subordinates, and whatever reports or output that they may get from them, so they use it for planning. So these plans can include setting of targets, or they can also limit costs. They can also predict production expenses, debt serve management, as well as achieve specific revenue, profit margin, and gross profit objectives. Okay, so basically, planning in terms of finance is very important for an organization because this will take them to achieve their organizational and financial goals and objectives. Okay, so the financial manager will create also a master budget as part of their planning, and this is also known as a budget variance analysis. So this will take account the company's balance sheet, accounts receivable and payable reports, as well as cash flow records and profit or loss statements. So here, master budget will provide them with the information on where do they get cash inflows, and it will also provide information about how they will spend the available fund or investment, and they have to make sure that at the end of the financial year they have an optimum balance of cash for them to still survive and continue as a going concern entity. Okay, so here he will regularly review the budget if their activities or actual performance is in line with the budget, okay, or if they are exceeding or they did not achieve the target, and so on. Okay, so this is the analysis of the variance between the actual performance and that of the planned from the master budget. Okay, so aside from planning, okay, so another goal of the financial manager is cost containment. So here, the financial manager will create requests for proposal, bidding processes, and purchasing policies for contractors, vendors, and suppliers. So this is the way to ensure that the company will get the best combination of quality and price. So here, what this description gives us is an idea of how a financial manager will decide and purchase, for example, or get the input at a minimum amount, but not having to sacrifice the quality of such input or raw materials. Okay, that's why they are undergoing biddings and proposals, so they will be able to evaluate which supplier to get a particular needed raw materials of the same quality and quantity that is being requested or needed, but with a lower cost. So a financial manager will also look at the company's current and future resources needs to determine if it is better to perform activities in-house or to outsource the work. So again, this is cost minimization activities. So which option will give them lesser cost but with the same quality that is being expected. So he also needs to manage the company's debts or liability and taxes to minimize interest payments and tax liabilities or penalties. So again, cost containment is minimizing the cost and expenses of the business enterprise. Okay, so another goal of the financial manager is cash flow management. So here, this is the actual receipt of money and payment of liabilities as opposed to that of the budgeted income and expense. So cash flow is actual inflow and outflow of cash, whereas budgeted income and expenses are just a sort of projection that the company will earn and spend for the next accounting period or operating period. Okay, so this is considered to be most important duty of the financial manager as well. Okay, so the goal of the company's cash management policy is of course to make sure that there is always enough cash or money to pay for the liability so that they will be able to keep enough credit and cash reserves. Okay, so that the company will be considered financially stable. So this is what we are talking about in our discussions under liquidity in the previous video lecture. Okay, so the next goal of the firm is legal compliance. So here, a financial manager must make sure that the business meets all of their legal obligations related to finances, which includes the payment of income taxes, employee benefits, governmental wage requirements, especially those which are required by the government agencies. Okay, for example, if they are a public corporation, so they must adhere with the legal regulations or laws under Securities and Exchange Commission. So of course, this is very important because once an organization will not comply with the legal requirements of a particular agency or authority, then they might be charged with penalty. Okay, so meaning to say additional cost or loss or expenses on the entity. Okay, so the financial manager must also ensure that the company meets the industry-specific laws. Okay, but here they have to handle these legal obligations. A financial manager might work with an internal team or consultants. Okay, so that they will be able to discuss things and make sure that everything are complied with. So for the tools, okay, so those are the different roles of the financial manager. So we go now to the tools of financial manager. So here the financial managers has to use many types of tools to ensure that the company the company will achieve its intended goals and objectives, as well as perform his duties and responsibilities with caution and credibility. So that is why there are a lot of techniques and tools that is present in terms of finance, okay, that is being used by the financial managers to aid them in creating or providing or suggesting strategies and doing their duties and responsibilities. So we have the following tools that are commonly used for financial management. So we have the first is trend analysis. So this trend analysis will be discussed in our next modules. So you students will experience how to do the trend analysis in financial statement analysis. Okay, so here the trend analysis is also known as a pyramid method. So this is studying the operational results as well as the financial position of a certain organization or company over a series of years. So we calculate ratios of the different items for the different years or period and compare this, okay, from the current or the base year. So here, if you do the trend analysis, you will determine if the company, for example, is increasing in terms of their profitability or decreasing, okay, and so on. So whether the enterprise is trending upward or backward. So analysis of the ratios over a period of time is done, okay, for us or for the financial manager as well as the management to determine if what they are doing so far for those periods or number of years. Okay, so the next is ratio analysis. Okay, so you will also experience solving these financial ratios as well in our next modules or lessons. So when we say ratio analysis, this is a quantitative analysis of information that is contained in our financial statements. So this is described as significant relationship that exists between various items coming from balance sheet or statement of financial position and a statement of profit or loss of a firm. Okay, so here you will determine you know that in your basic accounting, you know that in preparing financial statements, the accounts are interrelated with one another. Okay, so meaning to say there are items that are related to the for example, there are accounts that coming from the balance sheet or statement of financial position that are related to the accounts that can be seen in our statement of financial performance, okay, and so on. So these are used in the ratio analysis to determine the extent of the relationship, and it will give the management some sort of perspective, okay, on how they will do their financing decision, liquidity decision, investing, and so on. So you will learn more of this in our specific module under financial statement analysis. Okay. So the next is the cash flow analysis. So this is the actual movement of cash. Okay, just like what we have mentioned earlier, the movement of cash into and out of the business. So here, this is the difference, or we can also get a perspective or an information about the difference between the inflow and outflow of cash. So that is the net cash flow. So meaning to say, under the cash flow analysis, we will be able to analyze where does our cash inflow are coming in, and where do we spend the available cash. Okay, and then if there is any residual amount or additional needed fund. So the analysis of cash flow will explain the reason for a change also in the cash balance. Why is there a change between the beginning and the ending cash balance that can be seen in our balance sheet, especially if you are preparing a comparative financial position where we are presenting our financial statement from the previous year and the current year. So where do the difference between the beginning and ending cash balance are coming from, or where do we spend it, okay, and so on. So under the cash flow analysis, you can also analyze the liquidity of the enterprise, as well as the evaluation of our operating, investing, and financing activities. Okay. So aside from those mentioned tools, there are other electronic financial management tools that is being used as well. So these are the computer applications that help the financial manager in collecting financial data from the different divisions of the enterprise. Okay, so they also use these tools as well. There are a lot of available electronic financial management tools. Okay, so those are for the goals and tools of the financial managers.